Hello and welcome to another episode of your Retirement Planning Simplified. I am your host, and as always, with me, almost always, I guess, as of late, my co-host Lindsay Wilson. How are you, Lindsay?
I'm great, Joe. How are you?
I'm good, thanks.
About
Um,
to embark on a vacation to PEI?
yeah, sure we don't miss any weeks with the podcast,
That's
and then
right.
after that, it's pretty much packing for me.
Yes, that's right. Getting ready for the plane and all the fun ahead.
Yeah, and I guess by the time this airs, you may be done your play. I'm not sure.
This is what I suspect by the time that this airs. I was in a play called Jim Watt's Girl Reporter by Beverly Cooper, and directed by Kim Blackwell at Fourth Line Theatre in Millbrook, Ontario. So if it's before August 24th, come on out if you're in the GTA area and come see a great play about a piece of Canadian history, specifically a young woman's involvement as a reporter in the Spanish Civil War.
Yes, and as I mentioned on the last episode, it was great. And it's not just Lindsay promoting it. I did see it, and my wife Ash and I both loved it.
Yeah, great.
Oh,
Thank you. Thanks for coming. Yeah.
okay, so
So, yeah.
for investing today, we're going to kind of stick with our topic, kind of continuing off from our last episode. And I saw an interesting article that got me thinking about how people are always looking for ways to maximize returns and minimize their risk, right? Like we all want to make money, but none of us want to lose money, right? But obviously, there's a trade off there. There's a reason we talk about risk and return. And so, trying to maximize returns and minimize risk often leads Wall Street to sell us complicated solutions that claim to do these things. But what they typically end up doing is just add complexity and cost to your situation. Okay. Sam Sivarajan had an article in the Globe and Mail about a recent performance summary of the Canada Pension Plans Investment Board that I think kind of speaks to this topic. So, what I'm going to do is I'm going to have Lindsay read a paraphrased version of the article, and we'll put a link to the article in the show notes if
Hmm.
you want to read the whole
Hmm.
thing. But I'll have Lindsay read this, and we'll just talk a little bit about some of the downsides of complexity.
Hmm. So it's a summary from the high cost of overcomplicating your investments. So Sam Sivarajan, an independent wealth management consultant and author, compares the world of personal fitness to investing. Just as fitness is based on simple principles, despite the plethora of gadgets, investing is grounded in fundamental principles: buy low, sell high, diversify, and prioritize consistency. Sivarajan emphasizes that complexity does not equate to better returns. He references David Van Benschoten's management of the General Mills Pension Fund, which succeeded through steady, above average returns rather than aiming for top performances each year. Over 14 years, never ranking higher than the top 27% in any given year, but over the 14 years, he ranked in the fourth percentile. In 2006, the Canada Pension Plan Investment Board shifted from a simple, low cost strategy to a complex, actively managed approach, increasing costs and staffing significantly. Despite these efforts, the Canadian Pension Plan Investment Board performance lagged behind a simple passive investment strategy. This underperformance, costing $42.7 billion, highlights the risks and costs of complexity. Sam cites the Pareto principle, suggesting that focusing on core factors, consistent contributions, minimizing costs, and diversification achieves most goals. Research shows that simple strategies like equal weighted portfolios often outperform more complex ones. Even Harry Markowitz, the father of mean variance optimization, admitted to using a simpler approach in his investments. The key takeaway is to establish clear goals, time horizons, and risk appetite, and to remember that simplicity is the ultimate sophistication.
Thanks, Lindsay. So the last
Mhm.
line there sounds a lot like the way we left off our last podcast, I think.
I think so too. Yeah.
But I thought this was an interesting article to speak to, given the constant calls I get from portfolio managers who are trying to sell me on their sophisticated strategies to try to sell to our clients,
Mm.
and also given our conviction to implementing an evidence-based investment philosophy, right? So, excuse me. Yeah. So anyway, I think there were some good points in there, and today we'll talk a little bit about some of the points that we think are important about investing and how they apply to this idea of the cost of complexity.
Yeah, we'll talk about a few different topics related to the market and we'll get your thoughts, Joe. So I think we should dive in and start with evidence based investment philosophies or philosophy.
Yeah, so the whole reason that Sam wrote this article in the first place was because we recently had the report that the CPP investment board was unable to beat a passive investment benchmark. So that means had they just owned a portfolio of globally diversified ETFs tracking market indexes around the world, and just focused on their regular rebalancing, they would actually be further ahead than having gone through this process of complicating things, right?
Mm,
So it's not to say that there's no smart investors on the team, but it really does point out kind of that foundational concept of evidence-based investing, which is that markets work, right?
mm,
And so just to go a little deeper on how markets work, at the end of the day, every trading day involves millions of buyers and sellers buying and selling companies or stocks. And a someone selling a stock is not going to sell it unless they feel they're getting a fair price. And someone buying a stock is not going to buy a stock unless they feel like they're getting a fair price. And so what happens is the markets, the stock markets, bring together these millions of buyers and sellers to agree on the most fair price. So is
mm,
it perfect? Probably not. But it is considering the information that's available to all these millions of participants in the market, and that's what's helping determine the prices that we see. So it is very hard for any one person or one team of people to know better than the millions of participants that are buying and selling every day, right? So that's just saying that, if we trust that markets work and we bought that index portfolio, kept things simple, unlike what the CPP board did, in that case, they would actually be further ahead. The other thing is when we start complicating things by bringing in other types of investments. So a big part of what they've done with the CPP investment board is bring in things like real estate, private equity, private loans, all these different more complicated private type investments. And so, again, not to say that you can't find value or returns there, but all these things also cost more money. They're more complex, they complicate things. And it's, at the end of the day, there's costs, and those costs
mm,
will detract from returns.
mhm. So, what if we move on to just keeping things simple?
Sure. So, excuse me. If we talk about some of the core principles or concepts that we know hold true with investing, uh, it doesn't have to be complicated. Okay. So here's a few principles I've kind of jotted down here that if we can follow these few core principles, we're going to have a more successful investment experience. And again, this is all based on the evidence.
Mm,
So, number one, I've already talked about it, but markets work. So, we want to embrace market pricing. We don't want to try to outguess the market. We just want to let them work for us. Number two is we want to practice smart diversification. So it's not enough to just diversify to a handful of stocks from one company. It's also not enough to diversify, say, through with the Toronto Stock Exchange and own a few hundred companies in Canada. We want to globally diversify. So if we look at some returns, I can't remember the exact time period now that I'm looking back on this, but we have like a 20-year period where we can see returns of the Toronto Stock Exchange versus a global index. And what we see with the global index is we actually had lower risk, so there are less ups and downs, so to speak, and a higher return than the Toronto Stock Exchange.
mm,
So just showing us that while in most cases, there is a relationship between risk and return, there is a way to get a free lunch, so to speak, and that is through diversification, right? So we want to
mm,
make sure we're maximizing that. We want to resist chasing performance. So what I mean by that is, we talked a lot about how markets work and we can't outguess the market. But when people are choosing active investment managers and strategies, often what they're saying, or advisors might be doing this with their clients, they would say, yeah, we know that most mutual fund managers, for example, don't beat the market, but we only pick the winners, right? And essentially what they're saying is that they're chasing performance. They're looking at who has done well and trying to pick the managers that have done well, assuming that that means they're going to have success moving forward. And the reality is, even if we just look at those winners, there's a ton of data showing us that if we look over the next time period, so dimensional, Spiva, which I've talked about in the past, they've
mhm,
done, they show the numbers. If we're looking out over following periods, the chances often are actually less than we would expect by chance that they remain a top performer.
Mm.
right? So just because someone has done it before doesn't mean that they're going to do it again. In fact, they're less likely than chance to do it again. So we don't want to follow that as a strategy. We do want to consider the drivers of returns. So again, while we can't guess who the next winner is going to be, what company is going to be the next winner, we can use the science of investing to pursue higher returns. Okay, so there's no guarantees here, but research does tell us that value stocks or relatively low price companies outperform growth stocks or relatively high price companies. Excuse me. We also know that profitable companies tend to outperform less profitable companies, and smaller companies tend to outperform larger companies. Now, it's important to keep in mind here that this does not show up and happen every year. So just like we know, even though it's not what we want, but we do know that stocks do not outperform bonds or do not outperform cash every single year, right? On average, they've always outperformed, but not every single year. And so those drivers of returns are the same thing. So if we look back over the last decade or so, it's been a pretty tough go for anyone who's all in on value stocks or value companies. And we've actually seen growth companies doing a lot better up until as of late, actually. But anyway, the point here is that if we consider those drivers of return, what we're trying to do there is we're looking to overweight some of those areas to give us a chance at higher expected returns. And just like we want to have stocks in our portfolio, even though we know sometimes cash is going to be better, we want to stick with our strategies and let time work for us, basically. So let the markets work for us, let those drivers of returns work for us over time, and we don't want to switch up the strategy just because it didn't work out this year the way we were hoping, I should say. We also want to avoid market timing. So we don't want to guess when to get in and when to get out. And I've talked about this on the podcast many times. I feel like COVID is the perfect example of this. I know
Mm.
there was people who got out of the market before it went all the way down during COVID in March of 2020. And I had conversations with people, not clients, but other people who, whenever you tell someone you're a financial advisor, at times like that, they want to tell you all the great things they've done with their investments, right? So, having people tell me that, oh, in kind of mid-March, I was able to get out of the market before it fully crashed. But the problem with those people is that the market had recovered by around June of 2020, even though we had no vaccine, even by I think it was until December of 2020. So
Mm.
there was still a ton of uncertainty. So these people who got out of the market because they were scared of COVID, most likely and in most cases didn't get back in to the market. And at the end of the day, in 2020, it was a positive year, followed by
Mm.
another positive year in 2021. So how do you know when to get back in? If you're trying to time the market, you need to get the decision right twice. And again, we've talked about this enough on the podcast. Nobody has a crystal ball.
Mm.
We want to focus on your goals and we want to focus on what you can control. So in the last podcast, I went into some more detail of what that looks like. But again, unless your situation has changed, your goals have changed, you probably don't want to change your strategy. So you want to put the strategy in place based on those goals and your situation,
Mhm.
but you don't change it just because of what's happening in the markets or because you're trying to time anything. So those are some key factors to consider, principles to consider when we're thinking about investing.
How about the idea of avoiding expensive and shiny things?
Sure. So it's easy, and we see it all the time. It's easy to get pulled into the hype when it comes to investing, right? So when our friends are doing well, we have a fear of missing out. We want to take part in that action, right? So we think crypto, if we think of .com, and so now it's AI, kind of all that technology. And again, I'm not sure where things are when this podcast is airing, but there's a lot of rumbling in the markets right now of people worrying that the bubble is going to burst with AI.
Mm.
But we've seen a lot of good things in the last few years with AI is in particular and the big tech companies. So when you have that diversified portfolio where you don't have all your money in there and you see your friends who are maybe all in on some of these big companies that have done well, it can be hard to miss out. But just because that's the flavor of the day, what we do know again is those investment principles that I just went through, they're proven to work over time, and your
Mm.
retirement isn't something that you prepare for overnight, right? You should be
Mm.
preparing for that a long time ahead of retiring, and your retirement isn't something that just happens and you spend all your money at once, or or you're done investing as soon as you retire, you're hopefully going to be retired for 30 or 40 years. So we need to make decisions with your investments that are going to make sure you have income for the next 30 or 40 years.
Mhm.
And while choosing the right stock gives you the chance of getting rich, it also gives you the chance of going broke. So your portfolio should be set up in a way, again, that's following the evidence, and you're never going to get rich quickly from following a strategy like that, but you're also never going to get killed quickly following a strategy like that.
Mhm.
And the other thing that I would talk about is, again, there's always somebody who wants to sell you these more complex strategies, because we all want that silver bullet, right? We want to know, how do we just pick the right thing that's going to solve all of our problems and give us the perfect outcome that we're looking for. So keep in mind that the higher the promised return almost always comes with a higher risk. And so publicly traded stocks have been around for hundreds of years, and markets as a whole have continuously shown us that if we can trust in the collective ideas and innovations of the free market, our wealth is going to continue to grow, right? But just like the CPP investment board, and like most pension funds, they felt that they needed to invest in more private and complex investments. And it's not that these, like I said before, it's not that they have no merit, but they do have significantly higher costs, which again are going to offset returns. And in the case of the CPP board, those have more than offset the returns they could have got just by following those evidence-based principles, right?
Mm. Mm.
So maybe if just a couple more points on this, Lindsay. Um, there's also, when we start talking about these alternative investments like the private companies or private loans or real estate, all that kind of stuff, there's also different risks that we don't see with publicly traded companies. So one of them, for example, is the disclosure requirements are not the same as they are with like ETFs or other publicly traded type investments or funds. So I'll give you an example here. We had Arvin on the podcast probably a few months ago, I guess now, talking about CPP, but I was having an offline conversation with him, and he was at a presentation from an investment fund that did private mortgages. And so one of the questions that he asked the guy presenting is, why aren't they seeing their returns go up on this mortgage fund? And the answer from the guy presenting was that, well, that the mortgages take time to renew, so just because interest rates have gone up, we're not seeing those returns reflected right away. And then the next question that came out of the presentation was, well, how long is the average term of these mortgages? And the answer is, well, it's actually 2 years. So given the time when this was asked, then the question was back, well, okay, well, why are we not seeing those returns showing up in the fund? And then essentially the answer was, well, actually, the mortgage holders can't afford to pay the higher interest rates. So we've done what would be, I don't know if our listeners may have heard of blend and extend, which is if interest rates change, we can lock in by blending the rates we've already agreed to with the new interest rates to hopefully get us a lower rate. Like as someone who's a mortgage holder, that's what you'd want to do, right? So
Mm.
they called it blend and pretend. So essentially, they're just letting the mortgage holders, or the people paying the mortgages, sorry, to pay the same interest rate, because they know that if they raise the interest rate to where it should be, that they won't be able to afford it, and they're going to end up having to walk away.
Mhm.
And so, as someone who's looking to invest in the fund, all you're seeing is, okay, well, here's the returns. Everything they're saying about the fund looks good. But what you're not actually getting the full picture just from reading through the due diligence pieces, which is there's a lot of risk there, because the people who are paying the mortgages that are driving the returns actually can't afford to pay any more, and so they're obviously right on the line of potentially defaulting on their risks.
Mm.
So that's just one example. We also have like liquidity risk. So again, as an individual investor, if you need to get your hands on your money, and you might not be able to get it for 6 months or a year or longer, because if you have real estate, you can't just get your money on that, right? And again, that's all types of private investments.
Mm.
So those are just a couple of other risks to think about. It's not quite as straightforward. So again, if there's higher a promise of higher returns, we have to assume there's a higher risk there, even though it might
Mm.
not be apparent when we're looking at the investment options.
So Just to sum up, are there any key takeaways for retirees?
Yeah. So just focus on the fundamentals, right? So regular contributions, try to choose low fee investment options, maintain a diversified portfolio, let markets work for you. All the same things that I've already gone through earlier in this episode, and I've talked about on, dozens of other episodes probably at this point. There's a reason that the foundational principles of investments work. It's because they are based on evidence that has been proven, and it's not sexy, it's not exciting, but it works. So we want to
Mm,
continue to focus there, right?
mm,
We want to think about our goal setting. So have clear investment goals, understand your time horizons, understand your risk tolerance, and again, if you've built your plan based on those assumptions, those inputs, then you shouldn't have to make a lot of changes to your plan along the way. You should be able to
mm,
stick with it.
mm,
And thinking about risk management, we want to avoid overly complex investments that may introduce that unnecessary risk I was talking about.
mhm,
The CPP board is kind of, their returns speak for themselves. You're probably not going to get a bigger budget and more sophisticated investments and more sophisticated investors. And even there, we've shown the costs were not offset by the additional expected returns the CPP board was looking for. So while we may not get the return we're looking for every single year in that traditional portfolio, it does offer peace of mind in the sense that over time, those returns are quite reliable and they're going to help you accomplish your retirement goals a lot more predictably.
mhm, mhm. Any final parting thoughts for listeners?
No, so I think I've probably hit on enough and rambled on enough for this one, Lindsay.
Excellent. Okay. Well, I will, of course, put a link to the article in the show notes. And thanks, Joe.
All right, thanks for listening.
Take care.
Thank you for joining us for this latest episode of Your Retirement Planning Simplified. Be sure to tune back in for the next episode. And until then, we're here to help you simplify and succeed in your retirement planning.